Okay, name that too. Put in the comments if you know what that was. All right, so as you can tell by the thumbnail, today we're going to talk about the question of should Social Security's trust be invested in stocks? Now, of course, with the Social Security Trust Fund on schedule to run out in about 9 years, you see different proposals. We've discussed these before. I've had videos on this before. One of the proposals was Senator Cassidy of Louisiana saying, don't take trust fund money, but let the government borrow money and invest it in stocks. And he overlooked the fact that they would have to pay interest on it, and it wouldn't do anything to save the trust fund now. So let's discard that plan. In the past, President Clinton talked about something similar to that. It went nowhere. George Bush the younger, the second, talked about people being able to opt out of the Social Security Trust Fund and have some of their payroll taxes invested in stocks, but that went nowhere. So we're currently, money in the trust fund currently goes into treasuries. Every single dollar in the Social Security Trust Fund is invested in treasury bonds, and that's been going on since 1939. There's about 2.8 trillion in there right now. I got another number here for you. About $70 billion in interest on those bonds went into the trust fund in 21, and in 22 and 23 about $67 billion in interest got paid into those trust funds. So for those of you who say, the government never pays it back and they don't pay interest, yeah, the government pays it back and they pay interest. So, the whole idea of Social Security at first was, you can't put it in the stock market. It was 1935 when the program, first got approved, and it was after the big crash in '29 and the Depression, and nobody trusted the stock market. And the reason it was put in Treasury bonds is because it was the safest investment in the world, and it still is today. It's safe. The problem with that is, safe means lower returns. But still, people now, they look at, 2000, 2008, 2009, 2020, when the markets, 1987, I can remember very vividly, where the markets take these big dives and crashes, and people say you can't put money in the stock market that we're going to need to pay benefits. The problem with that argument is, and the good news is, the markets always rebound. They've always come back, and they've always gone higher. And right now we're back at all-time highs again. We're right there. Will that happen in the future? Can't guarantee it, but probably. On a long-term basis, the stock market is safe. The problem we have is right now we're not looking at a long-term basis. We have to shore up the program within 9 or 10 years. So currently, the interesting thing is and this is my calculation, I couldn't get this number anywhere. I sort of did what we called in business school a WAG, or a wild ass guess. And based upon the number of people, 27% of owners, IRA owners, took distributions in 2023 with a median amount of $12,000 a year. I did some math, I did some guessing on allocations, and I came up with about $350 billion a year that's being pulled out of the stock market as retirees tap those deferred savings accounts. That number is going to grow, and it's going to put pressure on the stock market because these are sales of stocks. So as you have those sales, you have to have new buyers constantly coming in that want to push up prices. It's working so far, but who knows how well that'll work in the future, or where the market would have been had those funds not been pulled out. But as the boomer numbers grow and retirements grow at about 10,000 people a day, there's going to be a lot of money drawn out of the stock market. Now, the idea of putting some of the trust fund money into stocks would counteract that. So if you can either, and it doesn't matter, it could be less, it could be more, but it would help counteract that. That's one good thing that comes out of this. And you look at it, there's hundreds of pension funds in the U.S., some extremely large ones, 3, 4, 5, 6, $700 billion. Mostly, I won't say mostly, but there's a lot of state, city pension funds. There's a lot of, I specialized in hospital work, not work, but financing in part of my career. And I looked at a lot of pension funds and hospitals, and they all invest in stocks. You might find one small little pension fund somewhere that is safe and invests in fixed income, but the way pension funds exist and pay out their defined benefits is by investing in stocks. And those stock allocations will typically be somewhere between 50 or 70%. And each of those pension funds has a model where they target a return. Typically, you'll see 7 to 8% annual return based upon their stocks, bonds. Some do private equity, some do some hedge funds investments. But the point is, they invest in stocks. They target a good return. The Treasury bonds that the SSA holds right now for the Social Security Trust are paying about an average of 2.7%. That number's gone up as interest rates have gone up recently. When interest rates freeze, they'll continue to go up because the new bonds will be at a better rate than the old ones. But eventually, rates will come down, and those rates will come down with it. So, as I said, 70 billion still went into the trust from those bonds, and at one time it was well over 100 billion, 110 billion annually going in the trust fund. But we have the problem now, the trust fund's starting to shrink. As it shrinks, there'll be fewer investments. As interest rates come down, if they come down, so will the payments of interest to the trust fund. So we have to do something. And my idea is, I like the idea of putting money in stocks, and it's got to be done correctly. There's a lot of issues with doing that we have to overcome. But the returns are too good to ignore over the long period. Right now, we're either going to have to raise taxes or raise the full retirement age or raise the cap on taxes, some combination to save the trust fund. And that's going to have to be done either way. But if at the same time we take some of this excess money we're now going to put into the trust fund and put it in the stock market, maybe the higher return somewhere down the road could help us either lower payroll taxes or increase benefits or lower the age. I don't know. 40, 50 years from now, who knows? So, clearly it's not going to happen overnight. So my suggestion is, we're going to see payroll taxes getting raised one way or the other. And again, whether it's a combination of raising the 6.2% that both employers and employee pay, to 7% or 7.5%, whatever that number is, raise the cap on earnings so more people are paying more of their income in taxes. And, you can get rid of the cap, but I don't think that's a great idea, but I certainly think we'd have to go higher. And maybe you raise the full retirement age. But while you do that, you do these in combination so you get enough, let's say 30% more revenue. And right now, we're bringing in about 1.3 trillion a year in taxes. That number's going up because, the number of employees are going up, wages are going up. So the money coming in the trust fund is going up. It's going out faster because of the number of retirees. So, if we could raise that, by 30%, we get, closer to 1.575 or 1.6 billion, now we've saved the trust fund for a while, and maybe we take 10% of that at first, 20% of that at first, and invest it in stocks. The issue here is, how do we do that? What stocks do we invest in? Ideally, you want to keep it in the U.S. You would invest in U.S. companies, but do you invest in every stock in the market? Do you invest just in S&P 500 or what? Small cap, mid cap? I think it would be best if you invested in a total stock market fund, but there's a problem. Whose fund? Vanguard has a fund, Fidelity has a fund, Schwab has a fund, they have ETFs. The cheapest way to go for the Social Security Administration would be either, typically an ETF is a little cheaper than a mutual fund, just slightly. And but someone's got to decide who they do it with. Someone's going to get a lot of money off of this. If you're talking about $300 billion a year going into these funds, someone's going to make a fee on that. But I don't think that's insurmountable. I think we can figure out how to do that and whose fund we use. That to me, that's not the biggest issue. There will be fighting over it. So, you know, I support it. I'd like to see it done. I don't think it will be done. I don't think people in Congress are creative enough to do this. You know, and it's got such negative response in the past. I don't know it'll happen. But let me know. Let me know what you think. Is this a good idea, bad idea? Why do you think it's a bad idea? Do you have another idea? Help me here. Help me. I'm trying to help Congress. You know, so as always, subscribe. You know, if you like my videos, please click the like button and comment. You know, I get so many good comments. What I'd like to encourage you to do is talk to each other. Don't just comment and have discussions with me. Have discussions with each other. We're all learning from this. So thanks a lot. Thanks for tuning in, and I'll see you next time. Bye.